Picture this. You're at a crossroads in your financial journey, weighing the best ways to grow your hard-earned money while keeping it safe. Stocks might seem thrilling with their potential for massive gains, but they come with equal parts excitement and risk. Savings accounts feel secure, but their returns often fail to keep up with inflation. So, what's the middle ground? For many, the answer lies in bonds, a less glamorous but reliable investment option. But are bonds worth investing in? The answer depends on your financial goals, risk tolerance, and need for stability. Bonds offer steady income, diversification, and a buffer against volatile markets, making them a cornerstone of balanced investing. Let's explore their merits and whether they deserve a place in your portfolio. Understanding bonds, the basics of stability. To appreciate why bonds might be a valuable addition to your investment strategy, it's essential to understand what they are and how they work. A bond is essentially a loan you give to a government, corporation, or other organization. In return, they promise to pay you regular interest, called a coupon, and repay the principal amount, the face value of the bond, when it matures. Think of bonds like a handshake agreement with a trusted party. Imagine lending money to your friend who needs funds to expand their business. They promise to pay you a set amount of interest every month and return the full loan after 3 years. Bonds work in a similar way, but instead of trusting a friend, you're trusting a government or corporation. What makes bonds appealing is their predictability. Unlike stocks, which can soar or plummet unexpectedly, bonds provide consistent returns. For example, U.S. Treasury bonds are often considered one of the safest investments in the world, as they are backed by the full faith and credit of the U.S. government. This stability makes bonds particularly attractive to risk-averse investors or those approaching retirement. Why diversification is key. A common piece of investment advice is not to put all your eggs in one basket. Bonds are an excellent way to diversify your portfolio, reducing overall risk while maintaining the potential for steady returns. Imagine you're an investor heavily focused on stocks. During a bull market, your portfolio may grow rapidly. However, when the market experiences a downturn, the value of your stocks can drop significantly. Bonds often move in the opposite direction of stocks, providing a cushion during times of economic uncertainty. For example, during the 2008 financial crisis, while global stock markets faced steep declines, U.S. Treasury bonds gained value as investors sought safer assets. A well-diversified portfolio with both stocks and bonds ensures you're not overly reliant on one type of investment. Diversification isn't just about reducing risk, it's about creating balance. Bonds help smooth out the bumps in your financial journey, offering a reliable income stream even when other parts of your portfolio falter. The appeal of predictable income. One of the most compelling reasons to invest in bonds is the predictable income they provide. Whether you're saving for retirement or simply seeking a stable source of cash flow, bonds can be a reliable solution. Picture a retiree named Mary. After years of hard work, she's ready to enjoy her golden years without worrying about market volatility. Mary decides to allocate a portion of her savings to bonds. Each month, she receives interest payments from her bond investments, allowing her to cover her expenses without dipping into her principal. This predictable income isn't just valuable for retirees. Even younger investors can benefit from bonds, using the steady returns to fund long-term goals like buying a home or paying for a child's education. Bonds are particularly attractive in low-interest rate environments, where savings accounts and money market funds offer minimal returns. Are bonds a hedge against inflation? One criticism often leveled at bonds is their vulnerability to inflation. Since bonds pay fixed interest, their value can erode when inflation rises, as the purchasing power of those interest payments diminishes. However, not all bonds are created equal. Certain types, like Treasury inflation-protected securities, TIPS, are specifically designed to protect against inflation. Take, for instance, someone investing in tips. These bonds adjust their principal value in line with the inflation rate, ensuring that the interest payments keep pace with rising prices. While regular bonds might struggle in a high inflation environment, tips offer a safeguard, allowing investors to preserve their purchasing power. Moreover, bonds remain a strong option for balancing risk in a portfolio, even during periods of inflation. Pairing bonds with stocks, real estate, or other investments can create a mix that benefits from inflation-driven growth while maintaining the stability bonds provide. The future of bonds in your portfolio. As financial markets evolve, so too does the role of bonds in investment portfolios. Interest rates, economic conditions, and market trends all influence the attractiveness of bonds. However, their fundamental qualities, stability, predictable income, and diversification, make them a timeless choice for investors. Looking ahead, bonds may play an even greater role as global uncertainty and market volatility persist. For example, in 2023, as central banks raised interest rates to combat inflation, newly issued bonds offered higher yields, making them more appealing to investors seeking income. This demonstrates how bonds can adapt to changing economic conditions, ensuring they remain relevant in diverse scenarios. For younger investors, bonds may seem less exciting compared to high-growth stocks or cryptocurrencies. However, as you near retirement or prioritize wealth preservation, their importance becomes undeniable. A thoughtful mix of bonds, alongside other assets, can provide a stable foundation for reaching your financial goals. To conclude, are bonds worth investing in? Absolutely. If stability, diversification, and predictable income align with your financial objectives. While they may not offer the thrilling highs of stocks, bonds provide a steady hand during turbulent times, ensuring you can weather market storms without losing sleep. Whether you're a young professional building your portfolio or a retiree seeking consistent income, bonds offer unique benefits that complement other investments. They are a testament to the timeless wisdom of balance and patience in financial planning. When used thoughtfully, bonds prove that slow and steady can indeed win the race. If you enjoyed this video, please subscribe for more useful financial insights. See you in the next video.